All right, everyone. So when it comes to trading the currency markets, the number one reasons currencies go up or down in value is down to interest rates. Well, outside the Bank of England, which is the UK central bank. And in this video, I'll be showing you why hedge funds right now, today, are betting on a weaker Japanese yen, a weaker Swiss franc, because of something called the overnight carry trade. And I'll be showing you why the US dollar is so strong in the currency markets, because investors are always trying to buy currencies with higher interest rates relative to other countries' currency with lower interest rates, okay? This is the number one reason why currencies go up or down in value. Once you learn this strategy, it will transform your currency trading forever, and you're going to thank me when you understand the fundamentals that really push currencies in the market. So guys, enjoy the video. Come and join my Telegram channels as well. You'll see exactly what we're doing. You'll learn the fundamentals of trading currencies successfully. And hopefully, guys, I'll see you in the channels. All right, everyone, welcome to this video on interest rates and currencies. By the end of this video, your trading of currencies is going to go through the roof, because your knowledge on understanding the overnight carry trade and why the bond market drives the currency markets all down to interest rates is going to transform the way that you look at trading currencies, okay? I'm going to show you right now that in these articles on Bloomberg I've been reading, hedge funds currently today, that are most bullish on the Mexican peso. Why? Because of something called the overnight carry trade, okay? Where they want to borrow in low yielding countries' currencies, meaning countries with lower interest rates, and buy the currencies like the Mexican peso that offer higher interest rates. It's called the overnight carry, okay? This is so important to understand. I'll really break this down for you in this video. We're also going to look at why hedge funds are boosting bets for the yen to weaken in 2024. Why? Because there's something called the carry trade. Again, another article telling you what hedge funds are doing in the currency markets. You're also going to see, again, why the Swiss franc right now, as of today, and this article came out today, Citigroup now sees the Swiss franc replacing the yen as the currency that traders are going to use for the carry trade. So this basically means they're going to be selling the Swiss franc to fund the purchase of countries' currencies with higher interest rates, okay? And it's all down to inflation. So I'm really going to break this down for you guys. And when you understand this, I promise you by the end of this video, your trading for currency knowledge is going to be on another level, right? So let's break down the bond market. Let's break down interest rates. Remember, a central bank raises interest rates for one reason, to control inflation, or they lower interest rates for one reason, to get inflation to their target. Most central banks have a 2% inflation target. Now, what 90% of people do not understand is the relationship between interest rates and the currency markets. Now, I'm going to explain this to you. When you're buying one currency against another currency, let's say you're buying the dollar against the Japanese yen, the interest rate set in the Bank of Japan is going to impact whether investors want to buy the yen or sell the yen relative to another country's currency like the United States, okay? So at this moment in time, this is where the carry trade comes into play. You're going to understand that right now in the markets, as we can see over here, we have in the United States interest rates at 5.5% in America. In Japan, interest rates right now are at the level of 0. Okay, so if you basically want to buy the Japanese yen in the currency markets, what you need to understand is if you sell the dollar to buy the yen, okay, and this is where the overnight carry trade, this is what they're talking about, you're not going to make any money on this trade, because if I sell dollars to buy the yen, I get paid no interest on the Japanese yen that I buy, but I get charged 5.5% interest on the dollars that I sell to buy the yen. So remember, if you say I sold USD JPY, you're selling the dollar to buy the yen, but you're getting charged 5.5% to sell the dollar, and you're not getting paid any interest to buy the yen. Hence why nobody wants to buy the Japanese yen. That's why hedge funds right now are bearish on the Japanese yen. Hedge funds boost their bearish yen bets, okay? On the flip side, what if we was to sell the Japanese yen to buy the US dollar? Well, I get charged no interest on the yen that I borrow to buy the dollar, but I get paid 5.5% interest when I buy the dollar against the Japanese yen. So I'm going to break down this and show you this and how it plays out in real time, and it's going to open your mind to currency trades. So remember, in 2022, inflation was out of control. Let's have a look at where inflation was in the United States at that time. Inflation by March was at 8%. Remember, the US Central Bank has a 2% inflation target, right? So the US central bank started to raise interest rates. The first interest rate increase was in March 2022. Here we go, okay? It went from 0.25% to 5.5%, and the Federal Reserve was steadily increasing interest rates aggressively until the last interest rate increase, which was in July 2023. Look at the US dollar against the Japanese yen. Remember what I just said to you. Interest rates in the United States started to go up. Now, another way of looking at this and understanding where interest rates are going is just looking at the 10-year US government bond interest rate. It's called the yield on a government bond. You can see in March 2022, when the Fed first started raising interest rates, the US 10-year government bond interest rate started to go up because investors were pricing in these interest rate increases. Look at the dollar yen at exactly the same time. The dollar yen really started to take off as interest rates were going up. Notice as soon as there's a drop in the 10-year government bond interest rate, so rates went from 1.7%, you can see it on the right hand side, up to 3.2%, giving the dollar a 13% move against the yen. And then you saw a little drop here in the bond yield where it went from 3.2% down to 2.75%. The dollar drops at exactly the same time by 5%. Soon as the interest rate starts to take off again and go up in value, you see the dollar yen go up in value at exactly the same time again, and then you get a drop in the bond market here, and no surprise, the dollar yen drops at exactly the same time. Then the bond market takes off again and goes up, meaning interest rates in the US go from 2.65% up to 4.32%. Look at dollar yen. It takes off at exactly the same time. You get a huge monster rally in the dollar against the yen. It goes up another 15%. Okay, and then the bond yields peak at 4.35%, and then they start to go down. And look what happens. The dollar weakens against the Japanese yen by around 14%. Notice how the bond market going up and down in terms of interest rates in the US, driving the dollar up or down. They literally move hand in hand. Soon as the interest rates over here start to go back up again in the United States, dollar yen rallies. Immediately you get a big move here. Look at this move, another 15% move. Soon as the 10-year government bond interest rate starts to drop over here, no surprise, the dollar yen starts to drop. So why is this happening? Why is it like a perfect correlation between the bond market and the currency markets? And then recently you've had another push up higher in the bond market. No surprise, look again, USD JPY goes up. Okay, so let's understand exactly what I was just saying to you. When interest rates in the United States started to go up in March 2022, the overnight carry trade, which is what I was just explaining to you, which we can get the spreadsheet up over here. Let's look at where we were. Interest rates at that time in the United States were 0.25%. Now, what you need to understand is that when you take a currency trade in the markets, if I sell the yen to buy the dollar, the broker is going to credit money into your trading account every day you hold that trade open. If you're selling the yen to buy the dollar, because remember, you're getting charged no interest on the yen that you borrow, but you're getting paid at that time 2.5%. So if you're a hedge fund, let's say you've got, remember, one lot is equal to 100,000 units. Let's say you had 1,000 lots open, yeah? Let's just look at like a hedge fund taking big trades in the markets, right? Okay, let's say you took this trade on and you sold the yen to buy the dollar. Now you understand that the markets are expecting interest rate increases by the Federal Reserve because they told the markets in 2022 they're going to raise rates because inflation was out of control. Let's say the markets knew, which they did, that rates are going to keep going up. Now, as the Federal Reserve raises interest rates, at this moment in time when they first started, if I sold the yen to buy the dollar, and at that time rates in Japan were at minus 0.1, I would get paid 35 basis points, which is 0.35% over 365 days to hold that trade open. Even if the exchange rate doesn't move, you're going to get money credited into your trading account every day. So look, a hedge fund could be making $1,000 a day in free interest coming into their trading account if they hold the trade open. Okay, if they sold the dollar to buy the yen, they'd be losing $1,000 a day because they'd be getting charged 0.25% on the dollars that they're selling, and they'd be getting paid no interest on the yen that they borrow. So look what happens as interest rates are going up from here. Investors who are getting that free money credited into a trading account, look how much money they make per day as rates go up. So as rates go from 0.25% to 0.5%, right? Look, the difference has gone up by 1,000. Now they're going to get paid $1,700 a day. Rates go to 1%. Now they're making $3,000 a day. Rates in the United States go to 3%. They're now making $8,000 a day. Rates in the US go to 5%. They could be making $16,000 a day. But imagine a big hedge fund. I'm talking managing billions, guys. Let's look at the lot sizes they could be making, all right? Now imagine you're taking big lot sizes and you're making 160 grand a day. Now think about it. All these big funds that are looking to make money off for their investors, what are they going to do? Of course they're going to sell the yen and buy the dollar. They all want to get into that trade, guys. That is the trade they want to get into because they're going to get paid 150 grand a day just to hold this trade open, even if the exchange rate doesn't move. So look what happens. As the interest rates in the US go up, all the hedge funds are all chasing this free interest rate called the overnight carry trade. Hence why you're hearing hedge funds are bearish on the yen after the Bank of Japan's latest dovish hike. And what they're saying over here is it's all about the overnight carry trade and where interest rates are going in the US relative to the Bank of Japan. Okay, so look, the anticipated rate hike by the Bank of Japan ultimately did little to narrow the gap between yields, interest rates in the US and Japan, where the yen remains the common funder of carry trades, in which macro traders, hedge funds, investment banks, sell low interest rate currencies like the yen in order to buy higher interest rate currencies like the dollar abroad, selling yen, buying dollars. So look, this is why you get a trade on in the markets where the dollar could go up against the yen by 30% in a single year because the difference in interest rates keeps getting bigger and bigger and bigger. So the overnight carry, the amount of money getting credited into these funds trading accounts gets bigger and bigger and bigger, and they all chase this return. That's why you see that 31% move. But look, interest rates peaked in the US in October and then started to go down during this period. Okay, so what caused rates in the US to start to come down during this period here? What was it that caused this decline in the bond market? Well, inflation at the United States actually came down for 3 months in a row. It peaked in July at 9.1%, and then for 3 months, it went down. 3 months always confirms a trend for investors. So you then saw the market predicting at that time rate cuts by the US Central Bank. They were starting to price in cuts saying, okay, the Fed's interest rate hikes have worked, inflation's coming down, maybe they'll cut rates. This is why dollar yen dropped after going up by 30%. It then dropped by a rate of 15%. Now, why would it go down by 15%? Because if the markets are pricing in rate cuts, then this overnight carry trade that they're making stupid amounts of money on may start to go down. So let's say you're making 150 grand a day, free interest credited into your trading account. Suddenly, let's say you're predicting rates to go to 3%. Look how much this goes down. Now you're making only 90 grand a day from 150K. So what do you think all the hedge funds are trying to do? Remember, I'm showing you how much they're making a day, but you haven't even taken into account they've also made a 30% appreciation in the exchange rate. So 30% plus another 5.5%, you're looking at a 35% gain. Imagine you're investing $1 billion and you've made what, 300 million. So when the exchange rate is at this level, they obviously don't want the exchange rate to then drop down here, and then their 33% return has gone down to 10%, because that could turn from 300 million down to only 100 million. So they all cash out on the trade when they expect interest rates to be lowered by the Federal Reserve. But the markets got it wrong because inflation lingered for longer. That was why the bond market then started to price in more interest rate increases by the Federal Reserve. And that is why USD JPY then started to rise at exactly the same time, because the bond market was pricing in more interest rate increases. And then coming into this year, the markets are currently pricing rate cuts by the Federal Reserve. That's why the bond market started to drop, and that's why dollar yen dropped by 7%. Again, for the same fundamental reason. They're trying to get the carry trade. They're trying to lock in their profits at the highest price, okay? And at this moment in time now, because of the recent economic data, we've had a bounce higher in the bond markets, and look what's happened again. Dollar yen has gone up against the dollar's gone up against the Japanese yen because the bond markets are going up. So what we need to do is to understand where rates are going. And look how I've just shown you that, right? Look at what investors are doing right now with the Mexican peso. For the same reason, funds are the most bullish on the Mexican peso in a year. Why are they the most bullish on the peso in a year? It's for exactly the same reason, okay? Look, you can hear it. Even after rallying the most in a quarter of a century in 2023, Mexico's peso is the best performing currency in the world this year, as higher rates globally and low volatility make it attractive. The currency's risk-reward ratio is double of its peers. The use of the Japanese yen as a funding currency has been popular with carry traders who borrow in low-yielding currencies like in Japan to buy the peso. So look, they're saying the reason they all want to be buying the Mexican peso is because in Mexico, and now I'm going to introduce you to this spreadsheet, which is where we actually can analyze where interest rates are expected to go in the markets. Over here, there's a spreadsheet that I use. You can fundamentally see at each meeting where central banks' interest rates are going to go, so you can know whose country has the highest rate. If one country's rate is expected to go higher than another country, so you know which currency to sell, which currency to buy, as I was just explaining to you. So look, currently right now, Mexico's interest rates are 11%. Let's say, look at Europe's interest rates, for an example, 4%. So look at that difference, 11% versus 4%. So if I was to, for an example, let's take Euro Mexican peso. Rates in Europe are 4%, rates in Mexico are 11%, right? If I sell the euro to buy the Mexican peso and I'm a hedge fund, I could be making 200 grand a day profit selling the euro into the Mexican peso based on interest rate differences, right? Now, more importantly, it's not just about where rates are going now, where they are now, it's about where they're going. And look, rates in Europe by the December meeting over here, rates in Europe are expected to go down to 2.95%. So there's going to be rate cuts in Europe coming this year. This spreadsheet tells you meeting by meeting where markets predict interest rates to go. So if rates are going to go down in Europe, right? So let's say they're 5%, 4% now. In Mexico, they're 11%. Rates in Europe are expected to go down from 4% down to 2.95%. And rates in Mexico are expected to go at the end of the year down to 10%. Sounds like a good trade to me, because if rates go in Mexico to 10%, the interest rate difference is still going to be 7% in Mexico's favor. Hence why hedge funds are the most bullish on the Mexican peso. And that's where they're talking about the carry trade. This is where the carry trade comes into play. And look at the Euro Mexican peso exchange rate. Boom. Big trend. Look at that. That is what you call a carry trade in full effect. Big move in a currency pair, down 35% for the same fundamental reason. It makes money to sell the Mexican euro to buy the Mexican peso. Who in their right mind right now is going to sell the Mexican peso to buy the euro? Why would you do that? You're going to be losing 7% per year on that trade. No one is going to do that, because they're going to be losing 200 grand a day if they take that trade. They all want to do the opposite trade. So now you're seeing the whole bigger picture as to what drives the currency markets. And it's actually, guys, not just about where interest rates are going. They also have to take into effect where is inflation going, because you need to know your real rate of return after inflation. So let's have, for an example, let's go back to USD JPY, right? Right. So this spreadsheet here is where we analyze the countries, the economies of different countries. Right. So the dollar's really strong against the yen. Why? Well, fundamentally, let's just look at it. Fundamentally, right now, if I sell the dollar to buy the yen, let's go back to this exchange rate as an example. Rates in the US are 5.5%. Rates in Japan are now 0%, right? Where are rates in the US? Sorry, where is inflation in the US right now? Inflation in the US is currently 2.8%, but it's not where it is now, it's where it's expected to be, right? So at the end of next year, inflation in the US is expected to be 2.39%. So let's take that into account. If I take this carry trade for USD JPY, right? Rates in the US are 5.5%. rates in Japan right now are at 0% in Japan, right? So if we go over to this spreadsheet here, if we take into account where interest rates are, where inflation is expected to be in the United States, then we can clearly see over here, rates are going to be at 2.3, inflation is going to be at 2.39%, whereas inflation in Japan going to be in the next couple of years. Japan we can see is at 1.42%, that's an expectation. So after inflation, I'm still going to get a real rate of return of 3% on the dollars that I buy, but I'll be losing 1.42% on the yen that I buy if I was to take the trade on the opposite direction. Of course you don't want to sell the fucking dollar to buy the yen. Why would you? You'll be losing money to inflation. But in the US, you're getting a real rate of return. So it's not just about where interest rates are going, it's about where the expected rate of inflation is going. So you guys who are trading currencies, if you haven't understood this, it's crucial to your trading. Notice this, the dollar went up against the yen during this period of time here by 35%, by 30%, right? As the bond market was pricing rate cuts. Notice something here. Why did the dollar during that same period of time only go up in value against the Aussie dollar, look, during the same period of time by 17%? Why 30% against the yen, but only 17% against the Aussie dollar? Because where are rates in Australia right now? 4%. So the interest rate difference between Australia and the United States, right? 4% in Australia, but 5.5% in the US. There's only a 1.5% difference compared to a 5.5% difference between the US and Japan. So do you see how currency traders are not really that interested, guys, in selling Aussie on taking this trade, Aussie dollar, US dollar, because the difference in interest rates doesn't give you that much money every night you hold the trade open. Look, 43K compared to 200K if you're taking the dollar yen trade. So whenever you're trying to take trades, guys, in the currency markets, we're always trying to match up who's got the higher interest rate, whose interest rate is going to be going up even more against another country. So the difference is going to widen in favor of the currency I'm buying, because you know that the hedge funds are going to be looking to use the yen as a funding currency, just like they're using now the Swiss franc as a funding currency to get this overnight carry trade on. Look at the latest, this came out yesterday. Traders are starting to turn to the Swiss franc as a top choice for funding carry trades instead of the yen. Why is it just the yen and the Swiss franc? They got the lowest interest rates. Everyone has higher rates. So when you're trying to get this money into your trading account, you're obviously always seeking who's got the highest rate in one country and who's got the lowest rate in another country. Let me take the country with the lowest rate. Let me sell that currency to buy the other currency. Let me get this profit on in the trade so I can make the highest amount of return. And as long as the difference in interest rates remains strong, and if it widens even more in favor of the currency you're buying, guys, now I've already shown you. This is why hedge funds are selling the Swiss franc, selling the yen to buy the Mexican peso or buy the US dollar, because they understand what the hell is going on, right? Here's another article today, come out today. Swiss inflation unexpectedly slows, vindicating Swiss National Bank rate cut. So today, Switzerland, their inflation data came out. Let's look at Switzerland. It came out at 1%. Inflation is now 1% below the central bank's 2% target. The Swiss National Bank cut interest rates just the other day. I'm now in a trade with my members, or we bought the euro against the Swiss franc, and we're in a good profit right now. Here is our entry price, and we're already in a profit right now. Why would we take that trade? Well, obviously, look at the difference in interest rates. It doesn't make sense. Switzerland's central bank's cutting rates, right? 4% rate in Europe, 1.5% rate in Switzerland, but where are rates expected to go? This is the key. In the Europe, they're going to go down to 2.9%, right? Call it 3%. Where are rates going to go in Switzerland? Down to 1% from 1.5%, What does that mean for us? That means that the interest rate difference is going to go from, where is it right now? Look, guys, pay attention to this. Please pay attention. The difference is 2.5%, right? It's going to go down to 2%, but because of this funding trade and the market's predicting that rates in Switzerland may go down to, what rate did we see over here? It's probably going to go down to 0.97%, which would mean another rate cut. So rates would be between 0.75% and 1%. So that would mean the euro will maintain the interest rate difference relative to Switzerland. That is why right now you're seeing these trades play out. Euro's going up against the Swiss franc. Look at this trend right now. Look at the US dollar against the Swiss franc. Look at this trend right now. The Swiss franc's getting weaker because the euro, the Federal Reserve, they're taking rates from in the United States this year from 5.5% down to 4.5%. So look, the interest rate difference is going to narrow slightly, but it's still very favorable to sell Swiss francs and buy dollars, because you're going to get, look, if you're a hedge fund, what's the difference? 3.75%. Hedge fund's going to look at that and be like, do you know what? I'm happy to take that trade, because as long as I don't believe there's going to be big swings in the exchange rate. Why would there be big swings in the exchange rate? Because no one wants to be selling dollars to buy Swiss francs, right? Who wants to do that? Because you'll be losing, if you're a hedge fund, 100 grand a day. But if they sell the Swiss franc to buy the dollar, they could be making 100 grand a day, right? So fundamentally, why would the dollar go down against the Swiss franc? Who's going to sell dollars and buy Swiss francs? No one. So as long as the exchange rate doesn't fluctuate that much, and when I say that much, it's because what you're looking for is basically, if you're making 3.75% free interest, as long as the exchange rate doesn't go down by more than 3.75%, so the exchange rate would have to drop like this much for your profit to get wiped out. But it's cool if it fluctuates 1%, whatever. But more traders are going to be looking, as I just said to you over here, more traders are going to be looking to sell the Swiss franc as a funding currency to buy US dollars, euros. Okay, guys? So now, this is important. The bond market always prices in the expectation for where interest rates are going. Hence why you saw that USD correlation against the yen when rates are going up. And that's why the bond market continues to go up or down based on the expected rate of inflation. So guys, to trade currency successfully, you need this spreadsheet to know where interest rates are going. You need to understand where the bond market is going. And this is what I teach all my course members, guys. The results speak for themselves. When you look at my shorts that I provide for you guys, members are killing it. Come and get involved. Come learn currency trading. The fundamentals drive markets, guys. Don't be doing this technical analysis stuff and you have no idea what's going on fundamentally. Because if you don't know where inflation's going, if you can't break down the US economy, know where inflation's going, if you can't understand and know where the markets are predicting interest rates to go, good luck trying to trade currencies, guys. You're going to be gambling and you're going to keep losing over and over again. So, hope that makes sense, guys. It's really interesting. It's fucking important. Come and get involved. Come learn how to trade currencies professionally. I'll teach you the fundamentals. And hopefully, guys, I'll be trading with you soon.